Everything seems to be going great. The S&P is up, tech stocks are partying like it's 2 a.m. in Miami, and Wall Street analysts are smiling like they just discovered a lifetime supply of Arby's steak nuggets. Meanwhile, Elon Musk is tweeting another bizarre idea probably involving a flamethrower, Dogecoin, and his neighbor in the metaverse, and everyone cheers like it's a national holiday. But underneath, the foundation is beginning to crack. Because while everyone is busy debating whether Tesla's next innovation will involve rockets or existential dread, there's a massive rigged game in the stock market that nobody is talking about, and if you're not careful, you're going to get burned faster than a Tinder date who claimed to be an entrepreneur but sells solar panels door to door. All right, let's strip the Wall Street nonsense. Stocks look like a fun carnival ride, but the ride is rigged. Imagine a giant game of hot potato, only instead of a potato, it's a digital grenade, and the pin has already been pulled. Here's the secret. The stock market isn't a fair fight between investors. It's more like a college freshman with a credit card, a sketchy uncle handing out cash, and a Tinder date promising big returns all crashing into one another while you try to buy a hot dog at the same time. The game is rigged because big money moves first. Hedge funds and institutional investors can manipulate prices with millions of dollars. You can't compete unless you have an army of interns or access to insider emails. And no, you probably don't. Retail investors are last in line. That's you. By the time the public hears a stock is hot, it's usually at peak hype and ready to fall like a failed TikTok challenge. Information is uneven. Some people get the tea before it's even brewed. The rest of us are just guessing while sipping Diet Coke in the background. Let's hit the numbers, because Wall Street loves them, and the rest of us should too. Hedge fund dominance. In 2025, the top 100 hedge funds control over $3.4 trillion in assets. That's bigger than the GDP of Canada. And they aren't playing checkers, they're playing 4D chess. Retail investors, you? About $200 billion, scattered across Robinhood, Fidelity, and whatever meme stock is trending on Reddit. That's like bringing a butter knife to a bazooka fight. Market manipulation alerts. In the last decade, the SEC has investigated over 200 cases of outright manipulation, from pump and dump scams to front-running orders. That's just the ones they found. Imagine how many are hiding under the floorboards. Here's the ugly part. Even when the headlines scream, stocks are soaring, a lot of the gains are artificial. Algorithms trade faster than a Snoop Dogg concert crowd running to the merch stand. Flash crashes happen, sometimes erasing hundreds of billions in minutes. And don't forget debt. The U.S. household debt is at a record high $18 trillion, up from $13 trillion a decade ago. Buying stocks with borrowed money is like trying to eat Arby's steak nuggets with chopsticks. You can, but you'll drop most of it and regret it later. Now let's talk about the happy headline versus ugly truth. Only a handful of mega cap companies think Apple, Microsoft, Amazon are carrying the entire market. Small and mid-cap stocks are stagnating or tanking. It's like watching one kid hog all the candy while everyone else gets a single jelly bean. Most retail gains are short-lived hype spikes. Meme stocks like GameStop or AMC, temporary explosions followed by gut punch collapses. Retail investors are usually the ones left holding the bag. Liquidity is a mirage. When the next crisis hits, it's going to disappear faster than Tucker Carlson's hairline under a windy day. History rhymes, folks. Let's flashback. 2008. Financial crisis. Banks sold mortgages like they were candy bars, bundled them into toxic securities, and pretended it was perfectly safe. Retail investors? Burned. Hedge funds? Bailouts. Government? Complicit. Classic rigged game. Dot-com bubble. 2000. Everyone was buying worthless internet stocks. Pets.com stocks? Gone. E-toys? Gone. Mega cap survivors? Amazon? Barely standing. Retail investors? Mostly broke. 1970. Nifty 50 bubble? Stocks with hype? No profits. The same pattern repeats today. Hot headlines, sketchy fundamentals, and a few insiders walking away with the prize while everyone else is stuck at the buffet line with soggy Arby's fries. All right, you're thinking, if it's rigged, Should I just quit and become a barista? Not yet. Here's how you can win even when the game is stacked against you. Step 1. Understand the players. Big money moves fast. Think of them like the sketchy uncle at a family BBQ who disappears with all the ribs before anyone notices. Retail investors follow the headlines. You, be slow, deliberate, and a little paranoid. Step 2. Focus on the few, not the many. Instead of chasing every meme stock, pick a handful of companies with strong fundamentals, those with real profits, not hype. Analogy. It's like betting on the real Arby's steak nuggets instead of the Instagram filter version. Step 3. Ignore the noise. Analysts, influencers, TikTok finance gurus, they're loud, confident, and often wrong. Treat them like your Tinder date who claims to be an entrepreneur but can't even pay for Uber Eats. Step 4. Use volatility to your advantage. The market is unpredictable, like Snoop Dogg's neighbor in the metaverse dancing on your lawn. Instead of panicking during dips, see them as opportunities to buy solid assets at a discount. Step 5. Risk management is king. Never invest money you can't afford to lose. That's rule number 1. No income, no job, and no assets? Then you are not playing this game yet. Quick reality check. Everyone thinks the market is a rising tide lifting all boats. Reality? Only yachts are floating. Rowboats? Sinking. Hedge funds are the yachts. Retail investors? Rowboats. ETFs? Inflatable pool toys. But if you pay attention, even a rowboat can sneak past the chaos. Especially if you avoid hype, pick quality, stay patient, treat volatility like free entertainment instead of panic. More ugly numbers to keep you honest. 70% of all U.S. stock market gains over the last 5 years came from just 10 companies. That's less than a decimal point in the grand scheme, like trimming lettuce on your Arby's sandwich and calling it a meal. Average retail investor return, 2 to 3% per year, barely beating inflation, let alone paying for your rent. Algorithmic trading accounts for over 60% of daily volume, moving markets in milliseconds while you sip coffee and check Robinhood. See the pattern? The market isn't fair. It's efficient for the big guys. So, what's the moral? The stock market is rigged, noisy, and often cruel, but it doesn't mean you have to be a victim. Quiet, gradual, and happening in plain sight, the system keeps rewarding insiders while testing the patience and sanity of retail investors. Doing nothing is not an option. So here's the question for you. How are you navigating this rigged game? Are you playing it safe, chasing hype, or carving your own path through the chaos? Drop your ideas in the comments. I want to know which strategy you think actually works when the whole thing is stacked against us. Remember, stocks are like Arby's steak nuggets at 2, and they look amazing, smell amazing, but if you're not careful, you're going to choke. Hit that like button if you want more brutally honest market breakdowns. Subscribe if you're tired of being misled by flashy headlines, and I'll see you in the next dive into the ugly side of finance.